as many of you know, for many years, I have subscribed to the Financial Times. They are not an advertiser. This is not a plug. Let me make that very, very clear. But the reason that I've subscribed is, it used to be basically, now they've got an American Bureau and an American edition and all that kind of thing, but it used to be a very British publication. And so you got this kind of European worldview, which I found fascinating. And secondly, it's always useful to listen in when the rich people are talking to the rich people. Right? I mean, it's kind of the premise of the movie The Butler, I guess. But well, actually, not really. But in any case, that's more of a Forrest Gump movie. It's a pretty good movie. But in any case, as a subscriber, once a week they send out a summary of the top stories of the week in email. And I got mine this morning. And it's called the Financial Times News Mine, the week ending Friday, 7th February. And every single one of these top stories is shocking. And I just have to share with you. And I think this is just amazing. It's got to be a coincidence, or we're much closer to an edge than I thought. Okay, the first story is financial. It's on lending by shadow banks, and it's from the February 6th edition of the paper. And here's the quote. And here's I'll tell you why it's significant first, and then I'll read you the quote, and so the penny will drop. Shadow banking is something that largely didn't exist before Graham Leach Bliley and the Commodity Futures Modernization Act. That's these institutions that are not regulated as banks, acting, doing things with money that traditionally was done with banks and was regulated. And the more of that happens, the riskier it is for our economy, because the shadow banking folks take incredible risks. This is where the derivatives trading is happening. This is where, these are the hedge funds. This is this kind of stuff, okay? Quote, banks issued 73% of the middle market loans last year, according to data from Thomson Reuters, down from 81% in 2012. It is the lowest proportion. In other words, banks are issuing fewer loans, which means the shadow banks are issuing more. It is the lowest proportion since the 62% share reported in 2006 at the height of the credit bubble. Now, in 2006, at the height of the credit bubble, we were down to the point where 48% of all banking, or 38% of all banking was being done by non-banking institutions, 62% by banks. Now it's 27%. I'm doing my subtraction wrong, aren't I? I should just stick with the numbers. It used to be that in 2006, this is a warning sign. Banks were only issuing 62%. In 2012, it was 81%. That's better. Now it's 73%, just 1 year later. This is not good news. Okay, that was from Friday's paper, or from Thursday's paper. From Wednesday's paper, this is about how companies are able to raise money, basically. In equity. In other words, people will invest in companies. Here's this big problem that people aren't investing in companies. People aren't starting companies. Instead, they're sitting on cash. And I did this story last week about how there's, literally almost a little over $2 trillion. In fact, here's the story. It was in the Financial Times. The headline was, "Huge cash pile puts recovery in hands of few." Just 5 companies sitting on $387 billion and over $2 trillion, just literally sitting in bank accounts or in treasuries or that kind of thing. Well, here's more evidence. February 5th, quote, "Companies have raised about $17 billion in equity so far this year in the wake of a sell-off in benchmark stock indices. This sharply down from $22 billion in the same period in 2013, according to Deal Logic. The slide in the sale of junk bonds is even more pronounced. That would be, companies that are new companies, smaller companies, startup companies, which are leading indicators of the economy. The slide in sale of junk bonds is even more pronounced. Corporate borrowers with fragile balance sheets sold $27 billion worth of debt compared with $43 billion the previous year, a 36% decline. When you see a year-over-year decline of anything, that's 36%. I pointed out to you before that in 2006, when I saw the housing market drop 34%, I said, that's it, the stock market's going to crash. Here you see this is in the corporate bond market. On Tuesday, the headline, or the story, the quote, the headline was on the performance of emerging markets. So these are the countries that are coming into the industrialized world: China, Brazil, Russia, India, etc. Right? The MSCI Emerging Markets Index is now trading at only 8.9 times expected earnings, compared with 14.4 times for global stocks as a whole. Emerging market equity outflows totaled $12.2 billion in January, according to EPFR Global. In other words, the emerging markets, the countries that were really starting to pick up some steam, the famous BRIC countries, Brazil, Russia, India, and China, they're not doing so well. And this is another bad leading indicator. And then they've got the Asian story and the miscellaneous story. Another one, Russia's economy. Growth in GDP plummeted from 3.4% in 2013 to just 1.3% last year. This is because their economy is so dependent upon exports of fossil fuels, I believe. Coffee beans rose 22% in the first 6 weeks of this year. This is a commodities bubble of some kind. Something's going on. Somebody's playing with this market. Gideon Rockman, in their recent book, Emerging Markets, Coase and Pradas show that the economies of a group of the most prominent emerging markets have grown by 600% since 1960, compared with 300% for the richer countries.
You're listening to the Thom Hartmann Program. Call 866-987-THOM.
All of this, in my mind, adds up to the fact that we are in another bubble. We need to stop the Reaganomics.